In this video, we're going to cover seller financing. It's one of the topics that I get asked about the most. Have you ever wondered how it's possible to actually cut the bank out of a deal, out of a real estate deal, and get yourself in there directly with the homeowner and have them act as your lending source? So this is the ultimate guide. Everything you're going to need to know about seller financing, whether you're a beginner or whether you're looking to do apartment complexes, and it's really not much difference in any of those scenarios. So let's go ahead and get started with the material. So who is this specifically for? Who can benefit from this information or this type of financing? Well, let's go ahead and talk about self-employed buyers. Self-employed buyers are one of the people out there who earn a lot of money, but they take some loopholes through their tax preparations, or the way their CPAs or accountants do their taxes, where they don't show a lot of income. Now, this may be one of you out there who maybe just started a business a couple years ago and you're still ramping up your income, but you're able to afford a housing payment, but banks are looking at you as too risky because maybe you don't have enough established time at your new employment, or maybe you don't have the enough income to show for the property, but you got plenty of a down payment. So this could work really well for self-employed people who actually earn more than they actually show on their tax returns. Next are for people such as foreign nationals. Now, specifically, I've been getting this requested by a lot of Canadians, or it could be anybody from any country. If you're looking to buy in the States and you don't have a established social security number here with credit built up on it, there are foreign national loans, but those are actually very difficult to get. They come with about a 30% down payment, and I don't know, maybe the terms are not that favorable. I think the interest rates are pretty high. But if you can find a homeowner that's willing to do seller financing, you may be able to skip all of that and actually get into a property with no, how would I say, hiccups whatsoever. And then lastly, this is for investors. People who are either just getting into the business of investing, who may not have yet built up a let's say a history of having real estate properties, because sometimes banks want to see that you've had management experience, then you've had ownership experience, that you've been through the gambit of owning real estate before. So if you're having a hard time getting a loan, seller financing may be a good option for you. Now, if you're a seasoned investor, someone who's done plenty of properties, you know how seller financing can be very attractive. And the reason why is because if you've ever tried getting a loan through a hard money lender, commercial lender, or any one of these banks out there, they ask for a lot of information, and sometimes it really holds up the process. Plus, if you're going to go the traditional route with financing multiple properties, let's just say you want to go 10 or 12 properties with conventional lending, well, you're going to get capped at how many properties you can actually have via the Fannie Mae guidelines. So doing a property like this with seller financing doesn't report to your credit. It's nowhere, it's not going to affect you in your other lending whatsoever. So it's actually really good. Now, if you're one of the OGs who's been investing for a long time and you're looking for bigger apartment complexes or commercial strip malls or anything like that, well, seller financing is going to be music to your ears, because that type of financing is very complicated. It's very difficult. You got to go through all types of environmentals and all these other issues. Not to say you shouldn't do those kinds of inspections when you do buy with seller financing, but it's much easier for you to get your foot in the door. So if you have very light credit, some people actually love buying stuff cash and they don't really establish enough credit. Now, I don't know nowadays, why you would do this, because it's better to always use the bank's money, pay it off at the end of the month, and then you can rack up some good incentives. But if you've never done that and you're very light on credit, well, you may want to also consider this as being a viable option versus renting, because obviously renting, you're putting money in someone else's pocket, you're not building equity. And right now we're starting to get into that time where it might be a good idea to start looking at owning versus renting, because as rent rates still are continuing to go up, home prices are now starting to actually come down. So this could be a good option for you. Now, how can we find these types of properties, and where do we find these types of properties? Where do we find motivated sellers who would be willing to do seller financing? Well, number one, the most simple and obvious way that people don't even realize it, including the majority of real estate agents don't even know to do this for their clients, you can actually search on the MLS under acceptable financing, and it actually says in there seller financing. You know, that's such a no-brainer, right? Why hasn't anyone tried that? Well, it hasn't always been this way. Not all MLSs offer this kind of option, but some do. So check with your real estate agent, whoever you're working with, or if you want one of our real estate agents to help you with that search, you can also contact us with the link down below. But this is one of the most easy and obvious ways to find a seller who would be willing to take that kind of financing. Now, the next way to do it is by looking up homeowners with high equity. This is for someone who wants to take the bull by the horns and kind of get their situation in their own hands, and you want to go out there and start soliciting homeowners who have actually owned their home for a long time and have a lot of equity in it, or even better, absentee owners, people who don't live in the house anymore, or maybe they rented and they have little mortgage or no mortgage on the property. And that's all information that you can actually find. If you guys don't know how to get your hands on some of the information like that, I'll leave another link down below for the software that I use. I've been using this software probably for the last 4 or 5 years. I've used a lot of different ones in the past, but this one seems to be the one that's been most accurate, easy to use, and the cheapest also on being able to pull up that information. So if you guys want to check it out, use the link down below. I am an affiliate with them, so it does help the channel if you guys check out that site. But definitely something you're going to want to do, especially if you're looking for investment opportunities. This is going to be something that is going to really benefit you in the long run. Next, we want to look at homes that have been sitting for sale for a long time. Now, what does a long time mean? That's a real relevant, how would I say, it's subjective, right? It's really subjective to the kind of market you're in. And it might mean 60 days in a really hot market that a property's been sitting for a long time. And you may want to pick up the phone and call the listing agent and say, hey, your home's been on the market for 60 days. Would the seller entertain seller financing? Now, the majority of the times you're going to hear a lot of no's. But after you call maybe 20, 30, 40 agents, maybe one of them might say yes. You know, it's not listed on the MLS as being that, but you know what? Maybe the seller was never given that option by their agent. Maybe you can bring up that option to them and maybe they're open to it. You know, be honest with you guys, it just happened to me today. I have a property that I've been trying to sell, and someone offered me someone said that he wanted to buy it, but they were short on cash, about like 50 grand. So what did I say? I told my agent in that area, I said, listen, why don't you just tell them that I'll hold the 50 grand mortgage and then they can pay the rest cash. You know, it's very simple, guys. It's not that complicated, but you got to ask. If you don't ask, the answer is always going to be no. Now, in a market that's, how would I say, probably like a buyer's market, I would say, kind of like a market crash, almost like we were in a housing slump that we were in maybe a decade ago. Well, in that market, you're gonna have opportunities left and right, and you're gonna see homes that have been sitting for 6 months. You know, 6 months, guys, is usually right before that listing is going to expire. So when you call that listing agent and you say, hey, listen, property's been on the market for 5 months now. 6 months is usually when it comes off. Do you think your seller would be open to seller financing? You know, I love the house, and I think it's a good opportunity for me. If I was able to come up with X amount, would they finance the rest? You know, that agent is going to be very open to trying to get that deal together for you. But remember, it's not always going to be yes, no matter what market you're in. It just has to be the right seller with the right opportunity, obviously with the right price, and they might be motivated to do that. Now, the last thing is look for commercial properties. What are commercial properties? Well, residential is anything between 1 to 4 units. That's considered residential. So if you're looking for a single family all the way up to a quadplex, I guess they're called, or 4 families. Up in the Northeast, we call them 4 families, but in a lot of places they call them something else. Now, anything above a 4 unit is considered to be commercial real estate. So let's just say a 6 unit, 20 unit, 100 unit. Now, the bigger in units you get, the more open a seller will probably be to seller financing. Why is that? Because those are very savvy type of sellers. And those sellers oftentimes have a lot of assets and not enough opportunities. So what happens is they're more open to act as your lender. Because why? Because they know that if they give you the mortgage, it's only for a short amount of time, and then once you're forced to refinance, they get not only their money back, but they're going to get their money back with interest, so they'll actually end up getting more off of that property. Very savvy, those people. So it's usually an option for the people who are not like first-time sellers. It's more for someone who understands how easy it could be to act as a lender, act as a bank. And guys, you know, banks out there are the ones that make the most money. How can you tell? Look at the nicest building in any city. It's usually a bank. And it's because they always win. Banks are a good position to be in, guys, if you could be a lender. Now, next is how can you negotiate terms, right? How can you negotiate the best terms? Well, number one, let's talk about the rate. What kind of a mortgage rate can you negotiate? Well, normally, or typically I should say, it's probably anywhere, give or take, about 1 to 2 percentage points of what normal rates are. So let's just say right now a going rate is 6%. Well, you can negotiate anywhere between a 4% if the seller is really desperate, all the way up to an 8% if the buyer is very, let's say, desperate or needy, of that property, or anywhere in between. Or sometimes you can actually match the actual interest rate that's on the market right now. It all depends on the situation, but anywhere between 1 to 2 percentage points off of whatever the going rate is at the moment, a 30-year fix, is probably what you're going to see, or whatever a commercial lender will give, depending on what your type of property is. Now, don't go in quoting residential rates if you're trying to buy a commercial place, because you're going to get laughed, out of town. Make sure you know what you're talking about when it comes to negotiating these terms. Now, next are points. What are points? Well, discount points to be exact. Discount points are basically prepaid interest. Okay, I'm not going to lose you. I'm going to make this very simple. Now, pay attention. So whenever I would want a lower interest rate, I can tell the bank, hey, listen, instead of me paying a 6% interest on my mortgage for the next 30 years, let me pay you 5%, but I'll give you some discount points up front. Now, those discount points may be 1, 2, 3%. It depends on what the lender is willing to give you, but it could make sense, because if you prepay that 1 or 2 or 3% of the loan amount, then what that's going to do is it's going to decrease your mortgage payment every month by a couple $100s. Now, what you have to do is do the math. How long is it going to take you to catch up to the upfront cost? If that upfront cost cost you, I don't know, $3,000, how many months is it going to take you to catch up to that initial $3,000 investment you made by paying those upfront points? Now, if you do that, and your recapture period is, let's say, 5 years, and you're planning on staying in that property for 10 or 20 or forever, maybe it's your forever home, then it probably makes sense. Now, keep in mind, rates tend to fluctuate, go up and down anyway. And if you think that interest rates may go down in 5 years, then there's probably no point in doing that, because you could just easily refinance into a lower rate later on in the future. But if you're going to be doing seller financing, typically points are not a thing, unless the sellers are really, educated, or maybe someone who's been doing this for a while. They may require you to either pay a point up front or maybe an exit point at the end. Okay, so don't be surprised if you see that. Next is the length of the mortgage. How long are you going to be a mortgage? How long are you going to be holding that mortgage for if you're the seller or if you're the buyer? If you're the buyer, how long can you hold that mortgage for, right? Well, typically it works like this. The mortgage rates are usually, and I say usually, based on a 30-year amortization schedule, which means the payments are going to be cast over a 30-year period, okay? It doesn't mean that the seller is going to sit there for 30 years and wait for you to pay off that last payment. That's usually not how it works, because banks do this because banks are entities, which means that they never die. But people die, so they don't want to hold your note for the next 30 years or 20 years or wait for you to sell one day. What they typically do is they allow you to make payments over 30 years, but they give you a period, an arm, which is called the balloon payment that's going to be due at the end of that, which means that, let's just say I gave you a $300,000 mortgage based over 30 years, but I want the repayment schedule to be in 3 years, or I want the repayment to be due in 3 years. So what that means is that for the first 3 years, I just want you to pay me, most of the times it's very easy to do it this way, I just want you to pay me the interest payments for the next 3 years, okay? Now, pay me that for the next 3 years, but within 3 years, I want my entire mortgage to be paid off. Now, how is someone going to pay off a $300,000 mortgage in 3 years? Like, is someone just going to pull out a check out of their pocket and say, here's 300 grand? Well, no. Typically what happens is this. Number one, the home has gone up in value, so they go to a bank and they refinance. They refinance with that bank because maybe their situation is different. Maybe the credit has been built up by then. Remember, this is good for someone with low credit. Maybe you're showing more income now on the books because you're self-employed, and now you've got to refinance this house. So maybe you're showing a little more income, paying a little more tax, but now you can refinance this with no issues. Or maybe you got your nationality status in this country fixed, so now you could do all these things. So in 3 years, what you're going to have to do is refinance and pay off that other loan, which is the private lender, the seller who had the loan against the house. They get their money, you get your new mortgage with a bank that's probably a commercial lender or nationally known lender, and you go on about your business, 30-year fixed, 15-year fixed, however long you want your mortgage for, and then you're set, you're done. And you can probably even refinance and cash out and pull out your initial investment if your home has actually gone up in value enough. Now, the other way of paying back one of these loans is asking the seller to actually give you a modification, or maybe a refinance with them, because maybe in those 3-year period, in that 3-year period, your situation hasn't changed and you need more time, or maybe the economy has gone down and your home is not worth what it used to be, right? Because these things do happen, guys. It's not always up and up and up. It sometimes goes sideways or down. So if you have to do that, keep in mind you're probably going to have to maybe renegotiate the rate, maybe renegotiate points, maybe renegotiate the term, how much longer they're going to give you. Maybe they'll only give you an extra year instead of giving you another 3-year period. So this is something that you may have to encounter if things don't go your way. And the last way of paying back your lender is selling. So if you sell your property, then obviously you can pay the lender back. They go away, they get their money, and then you go on and you keep the difference. If there is a profit, you keep the profit, which is pretty simple. Most people aren't going to argue with that, but that's obviously a way of get out of it. Now, like I mentioned earlier, amortization schedules are, how long the periods, how long the payments are going to be calculated over. So over typically it's a 30-year period, but don't be surprised if you see 25 years, because commercial lenders a lot of times do 25 years. So you may see 25 years on some of these bigger properties like multifamily, 100 unit, 300 unit. It might be something like that. Not something completely out of this world. It's just something you got to deal with. Now, the down payment. How much money do you have to work with? Because this is not a situation where you're walking in with no money out of pocket. I still, to this day, I don't think I've ever met anyone who's done. If you have, leave it down below in the comments. I have not met anyone who's done a seller financing deal with no money out of their pocket. Is it possible? Yes, anything is possible, but it's a lot of risk for the sellers to take. So typically what I'm seeing is 20 to 30% down. If you can negotiate any better than that, God bless you. If they ask you for more than this, it's not atypical. It happens. The one I'm looking to do right now, the buyer's putting in the majority of the money. They're putting in 70 or 80% of the money, and I'm only going to be holding a small percentage of the mortgage. So not a bad situation at all for either one of us, because we both have a necessity. Now, how can we get out of it? We spoke about this earlier. This is called the exit strategy. A lot of times the owner is going to want to know, what is your exit strategy to get me out of this mortgage? Because I'm not a bank. I'm not collecting mortgages. I want to make sure that I get my money back with interest. Well, like we said earlier, refinance with a traditional lender. What is a traditional lender? Traditional lender is called Wells Fargo. You can walk into a Bank of America, a Chase. Those are your traditional lenders, right? Those are the ones that you're going to normally see. Maybe you get an FHA loan, or maybe you go conventional. That's what you're going to see as traditional lenders. Then you can go with a commercial lender. What is a commercial lender if you don't go the traditional route? Well, a commercial lender looks at your asset more as its own type of vehicle, as such as, can it carry itself? Is it an investment property? Will it pay for itself every month and still have cash flow? Now, those commercial lenders are typically credit unions, or you might have special funds that are put together that are basically just trying to get a good return for their investors. So they go after just commercial types of loans for investors. So that's another option you may have. Then you also have private lenders. Now, private lenders are like your hard money lenders, or your very niche type of situation. They're not the cheapest. You're typically going to see double-digit interest rates, and they're only going to be considered to be bridges, which is going to be anywhere between maybe 1 year, 18 months, 2 years tops. That's really what you're going to see in that type of a scenario. Or if you're very sharp and you do have the ability to do so, you can actually talk to your friends and family and ask them to actually utilize some of the money they may just be having laying around, maybe in the bank, that's not earning them any interest. Imagine if you go to maybe 12 people and 5 of them say, yeah, you know what, that sounds like a good idea, and you have a $300,000 mortgage, and you ask 5 people for $60,000 a piece. Now you can use their money and actually have them act as the lenders, and then you can pay them a 6% interest rate if you wanted to, for however long you needed to. And that's actually more of fundraising type of a scenario, and that may involve a little more work on your end, to make sure the legalities are there. You want to talk to an attorney if that's something that you I think is an option for you. But if you're an investor, this is a great way for you to start buying properties. Go to your friends and family and start asking them to see if they'd be willing to contribute into a fund that you're putting together, and then see what kind of a realistic return you can offer them. Because remember, guys, you can't offer them something that's not realistic. There are certain things that you have to be careful with, but that's a video for another day. Now, lastly, you can sell. Like we spoke about earlier, selling is actually one of the best strategies for investors. You buy it, you fix it, you use someone else's money while you own it by doing seller financing. You use your money to fix the place up, and then you get it off your plate and you make some money. All right, nothing better than that. Next, pros and cons for the buyer. How can the buyer benefit from it, and how could he maybe take a somewhat of a loss from it, or maybe how can he not be in the best position? Well, pros: speed of the closing. Oh my God, I cannot tell you how awesome it is to not have a bank involved. Nowadays, banks take forever just to give you a mortgage. They ask for so much intrusive stuff, rightfully so. I mean, we went through a period where it was too easy to get a mortgage, but now we've kind of come the opposite way, and it's very difficult. But if you can close it quick, great. Access to buying. Well, some of you buyers out there, you don't have any other option. You're either going to use seller financing or you're going to rent. So, having an access to doing this is invaluable in my opinion, especially if you get in the upswing of a market that's going up. Hey, you can make tens of thousands of dollars by utilizing this scenario in just a short amount of time. So why not, right? Now, better terms. Now, better terms is all relevant, obviously, because you can have better terms on your mortgage than you would normally if you went to a regular lender. Yes, that's true. And you can also pay less fees. You can also, it's just better in a lot of ways, right? Your terms could be much better. So if you're looking to do this kind of option, there's going to be some benefits for you as a buyer. But now, what are the downsides? Well, some of the downsides is that you're in a weak negotiating position. Because you're not coming to the table with the money. You don't have a blank check to write off and just say, here's the money for your house. So you're in a weak negotiating position, which means you're most likely going to end up paying a little bit more for the house. You're going to be paying a little bit more for the property because obviously it comes along with an ease of financing. They don't have to do this, but there has to be some incentive in there for the seller to want to do this. So it usually comes with paying a little bit more for the property. Next is you might actually end up paying higher rates instead of lower rates. This is one of the things the seller could ask for. Maybe the seller gives you somewhat of a good deal on the house, but maybe he gives you a jacked up rate. Maybe he gives you a little bit more, which, hey guys, you know what? It's just cost of doing business. I've paid double-digit rates plenty of times just because I factor that into my overall costs. And limited time. What does limited time mean? Well, you're not going to have that loan forever. So you're going to have what we spoke about earlier, a strategic exit, right? You're going to have to, how do I get out of this thing? So make sure that you understand that time goes really fast, guys, really fast. Believe me, I've had loans that I'm like, oh my God, out of nowhere, they're due. I'm like, how the heck am I going to get out of these? So you don't want to leave getting out of the loan or refinancing. You don't want to leave that for the last month. You want to make sure you start working on that refinance at least 6 months before it's due, because nowadays they do take a long time, guys. And added costs for your second refinance, because if you're going to buy it initially, there's costs associated to buying it. And then when you refinance, there's costs associated to refinancing. So it adds a little bit more money to the overall cost of the home. But like I said, it's probably worth it if you're buying real estate, because real estate tends to trend up. Maybe not every year, but over time it does trend up. Now, what are some of the pros and cons for the seller? Let's talk about the first pro, which is the speed of closing, because speed is beneficial for buyers, but it's also beneficial for sellers, because sellers are selling for a reason. It's usually because there's some type of pain associated to it, or some kind of necessity, or some kind of inconvenience. So speed for them is just as important as it is for you. So believe me, I'm one to tell you that's definitely true. Tax benefits. Now, tax benefits are great because the seller, in essence, is not getting a capital gain from actually selling you that property, because they're not walking away with the cash. They're walking away with a note, which a note makes you a passive type of investment instead of it being a short term, or maybe it's another type of income, because maybe the seller has owned it for a long time, but they're still going to get pretty heavily taxed on that money. But if they give you a mortgage, then they become a note holder. Passive income. You guys ever heard being passive? Well, passive is a strategy that's really beneficial to sellers, because that means that income is taxed very lightly, very, very lightly. And if they have the wherewithal, they can even keep that as an asset on their books, which can be transferred to their heirs, or something happens to them, Or if they're very, very savvy, they can actually sell that mortgage to another mortgage holder, maybe a company that actually holds mortgages, So definitely a lot of ways for a seller to benefit from it in tax purposes. Now, they can also, they get more for the property, guys, in two different ways. How? The first way is because they got a better negotiating power. They can ask for more for the property. So that's one way they can capitalize better. And they can also capitalize better because on top of getting what they wanted for the property, they're also going to be collecting interest for the next X amount of years. So you add those together. Maybe the person wanted 500 for the house and they end up getting 600 when you factor in all the extra interest that they paid over the amount of years that however they're willing to hold it. So that is a very nice position for a seller to be in. Next, prolonged payout is one of the cons. So yeah, there's some downside. Maybe maybe the seller comes up with an opportunity in 6 months that they need the money for, but unfortunately that money's still tied up. They've only got a small portion of it and they need that other money, but guess what? They gotta wait. They gotta wait for you to refinance. They gotta wait for you to sell so you can get that money out. And then you might miss that opportunity. It's a prolonged payout. Missed opportunities is exactly what I wanted to tell you, is that if you miss an opportunity, what is that going to be worth to you in the future? Are you able to maybe double your money in an investment, but because it was locked up, you didn't do it? That's a downside. That's definitely a downside. And another thing is that imagine being a seller who did a seller financing deal right before the pandemic. Let's just say right before, in 2019, right? They did a seller financing deal, thought they got a great deal for it, held a 5-year note, and they've seen the home appreciate by 100, 200%. And they're like thinking to themselves, damn, I should have just held the property for the extra year or two, because now this person I'm doing this loan for is actually benefited way more than I'm benefiting from it. Well, unfortunately, those instances do happen sometimes. Sometimes it happens. The appreciation goes nuts, and the seller is kind of like, damn, I should have just, every time I'm collecting this interest, yeah, it's great, but I'm looking at how much your home has gone up in price, and I wish I would have been in your position. So missed the appreciation. It could happen. Not always, it doesn't always happen. Obviously, it's a freak situation what we just had happen, but it does happen. So that's one of the cons. And the possibility of a foreclosure, right? What happens if I give you the mortgage and then you don't pay me? Well, guess what? You're going to have to probably spend another $3,500 to $5,000 on legal fees to actually get that person to give up the property through a foreclosure. Now, some states, it's easier to foreclose than other states, such as let me put it this way, any state that's in the Northeast or maybe California. I mean, I don't know so much about California, but let's say the Northeast, very difficult. New York, New Jersey, very difficult to foreclose, guys. It takes years, even for the bigger lenders. All right, so now let's talk about the conclusion. So what do we actually think? Is this a good idea? Well, it's a no-brainer for a buyer or for an investor. Now, if you're a type of buyer that has A credit, you can get a loan anywhere with your eyes closed and go for that. If you can get a really low interest rate, or you can tap into cash, or you can tap into an equity line, then yeah, obviously you can take those routes. But if you don't have those options and you need something creative, or if you're an investor that's looking to leverage more deals, definitely something that I'd be looking into. Now, if you're a seller, let's talk about if you're a seller. Now, a seller, you're only going to want to take this option if you don't have a better use for your money. If the money that you have locked up in that home is going to be how would I say, like a thorn in your side, and you're not going to be able to access that cash because it's locked up for a certain period of time, then it's probably not the best option. But for a lot of sellers who don't have other opportunities on the horizon, or are scared to have a big tax implication, then this could be a really good option for them as well. Now, keep in mind, guys, these opportunities are not always going to pop up, but as the market starts to change, this is what you have to remember. As the market starts to change, these are going to be some of the creative ways that you're going to be able to help people. You're going to be able to help a seller if you're a buyer. You're going to be able to help a buyer if you're a seller, or if you're in real estate. Putting these two people together is going to be invaluable. I've helped, I think off the top of my head, at least 3 people do this situation, and that's 6 people because you've got a buyer and a seller in each situation. I've helped people in the past, and within a few years, those buyers have gained $100,000 thousands of dollars worth of equity, and the sellers have gotten these headaches off of their hands because they didn't want to be owners anymore. So yes, you can change lives, you can change your life. You just need to know how to utilize these tools. So in this upcoming market that we're in, or we're going to be coming in soon, these are some of the things you want to keep handy as a tool, because if you're able to use it, if you're a buyer that's looking to leverage more properties or get your first home or whatever the case may be, definitely an option that you're going to want to entertain. So if this was the information that you have been looking for, well, you're in luck, because it's only the tip of the iceberg, or we're just scratching the surface with this kind of information, because I am working on a real estate course where I compiled over 20 plus years of my knowledge in investing and in real estate into a very condensed and concise course. So you're not going to want to miss that. There's a link down below where you can sign up for an early bird special. So please take advantage of that right away. Also, if you guys enjoyed seeing content just like this, please let me know down below. Give this video a like and share it with anyone who you think would also enjoy this information. And if you want to see more videos from us, go ahead and use one of the ones on the screen right now. And I'll see you over there in just a few seconds. Thank you for watching. I love you, and I will see you next time.